I have absolutely no reason to believe that money will be the instrument that preserves purchasing power well over the next 10 years. Anything worth doing is worth doing now. There's no point in postponing things today.
You have now spent 25 years operating in financial markets, analyzing markets, and managing other people's assets. What have you personally learned from managing other people's money?
It's interesting in that sense because when I think about my overall experience, the way people perceive risk is really fascinating. It's really fascinating, specifically in the sense that, for example, in their own business, when it's their own business, you can basically see it right away. You realize that they take on enormous amounts of risk, almost unimaginably so. And then if you put that same person to do something on the markets or maybe, well, let's say, I think when someone tries investing in the markets, they find that everything seems as risky as it possibly could be, even though actually, well, those risks in their own business and in the context of the markets, those risks might, to exaggerate a bit, differ by an order of magnitude, but the risk in the markets is clearly perceived as much greater.
How important do you think financial literacy actually is? Because when we talk about people who have accumulated capital through entrepreneurship, for example, often they lack financial education, and none of us really got any financial wisdom at school. So how much do you think this actually affects people's behavior?
Well, it definitely has an impact. In that sense, the situation has actually improved, you could say. Of course, there are still examples where, to put it mildly, things are not going well. On the one hand, the general level of financial literacy is gradually improving. But on the other hand, many people still find they can't clearly distinguish or differentiate between various types of investments. For example, one specific investment might be extremely concentrated in a single asset class and carry a very high level of risk, while another is highly diversified and carries only a moderate or average risk. These very different things often end up being grouped in the exact same category in people's minds. And that clearly leads to significant financial misunderstandings and problems. Overall, the situation regarding financial literacy is still improving because, well, people at least have the second pillar, which is doing well. Then there's the third pillar. And at some point, they may have realized that if they have a long time until retirement, they could actually take as much risk as possible. Well, as much risk as is possible in the context of a pension fund.
Based on your experience, what is one piece of advice you would give to a beginning investor? What would best convey that advice? For example, you've already talked about this. Okay, you should get started, take your first steps, pension pillars, index funds. What other advice could there be for those who are hesitant and doubtful about whether they should invest?
If you haven't taken the first step yet, then basically everything worth doing is worth doing today. There's no point in postponing it. I know quite a few people, and I've made this mistake myself. Well, okay, I haven't postponed things for years, but I have postponed for weeks and months. And if you keep putting things off for weeks and months, basically nothing gets done. Then you simply miss out on something. Everything worth doing is worth doing today. I have some longtime friends and colleagues who have, with a slight smile, calmly said that you should buy when Koppel says so, not when Koppel himself buys. Because, well, getting to the point where he buys himself might be a bit too much. In short, it's worth starting today. And the second thing might be that, well, let's say this is my personal opinion, and it might not align so well with some people's risk tolerance, but I have absolutely no reason to believe that over the next 10 years, money will be the instrument that preserves purchasing power well, which means that, well, you still have to take some risk if you want to preserve the purchasing power of your savings. And actually, well, even in a slightly shorter perspective, if we're looking at, I don't know, 3 to 5 years, then even being risk averse myself, I would choose something other than money as an accumulation vehicle.
How much have you actually built your own personal asset portfolio during the time you were managing other people's money? Did you also think about building your own portfolio? And what have your preferences been in terms of asset classes?
Yes, of course, I have a portfolio. And if we now think in terms of when it comes to so-called risk categories, I have to admit honestly that most of the time I am clearly bolder with risk than I could ever be with clients' money because, well, with clients' money there is a very clear framework. Let's say, for example, that the highest risk level for clients is 4 or 5, then my own risk level is somewhere around 6 or 7. But has this truly given me any substantial or meaningful competitive advantage or benefit? I dare say it has been rather less than expected, because if we were to look at it from a different perspective, I have taken on a significantly higher level of risk and had to endure much more market volatility. But the so-called marginal difference in the actual financial returns has not been significant at all. So in that sense, it really comes down to what kind of specific psychological makeup and character a person has in the long run.
But which asset classes seem attractive to you?
Let's put it this way. I am primarily a dedicated fan of both the stock market and global commodities. That is largely because when it comes to stocks, I truly want to be actively involved in something where tangible, real-world value is being consistently created, so to speak. It is a space where you can actually talk about genuine long-term growth and development. And with commodities, it is simply fascinating that, for one thing, they serve as a very effective tool to help hedge against the persistent risk of inflation over time. And one more important aspect to consider is that, well, if you investigate the situation a bit more thoroughly, at least you can create the comforting illusion for yourself that there is a certain underlying sense of logical progression behind these market movements, which you can then try to place within the much broader context of the global economic cycle.
When it comes to stocks, do you mean the growth of the stock price, or are you more interested in dividends?
Actually, I like both, but what I really like is the concept itself, the idea. With growth stocks, well, the thing is that their price already factors in some kind of expected future growth,
Value.
When we consider future growth potential, yes. But what I really mean is the actual performance of the stock itself, or the stock markets as such. What it essentially boils down to is participating in what you might call a wealth-creating machine, and the wealth-creating machine really is the stock market, with its long-term real returns of about, 6+% per year. Where else can you get that? Okay, you have to be patient, but think about it. Where can an ordinary person get real returns like that? Earning a steady 6% return every single year without necessarily taking on a particularly high level of risk is a solid goal. Of course, you could choose to work incredibly hard in the world of entrepreneurship and business ventures, and here people might frequently talk about all sorts of different investment strategies like traditional real estate, stock markets, and this and that, and basically everything else you can imagine. But if we truly sit down and think about it carefully, it is definitely possible to build wealth, right? Simply by consistently investing small amounts of money over time. By stretching the investment horizon quite long, but where can an ordinary person get that? In my opinion, there aren't many options.